All right, welcome to today's training on how to prepare financial statement, how to get or generate financial report, either for clients or in office as an accountant. But before we dive into the practical section on how to make post or how to make entry into accounting software, either it's of Excel version or QuickBooks version or Sage version, we need to look at some certain things. For instance, before you make a post into accounting software, you must understand principle of double entry system. It's very, very important. So let me take you very quickly and take you through principle of double entry before we begin the practical on how to make entry into an accounting software properly for you to get an accurate result. All right, let me ask you a question, very simple question. If money leaves your business, where does it go to? If money enter your business, where does it come from? Many people say accounting is hard, but the truth is this. If you understand one rule called double entry, accounting becomes easy for life. Today, in the next few minutes from now, I will teach you the double entry principle using real business situation, not grammar, not theory. By the end of this video, you'll be able to record transactions like a professional accountant. Most beginners fail in accounting because they try to memorize rules like debit this, credit that. But accounting is not memorization, accounting is logic. Anytime accounting happens in a business, two things must happen. That is why many business owners don't know where their money is going because they record only one side of the transactions. They record only one side of the activities, which is the finance in nature. All right. So the double entry principle simply says every transaction has two sides, has two effects. One account is debited and the other is credited. It's as simple as that. No transaction affects only one account. If if one side receive value, another side must give value. All right. So debit is the receiver, credit is the giver. I repeat again, debit is the receiver, credit is the giver. All right. So before we do any practical, you must understand the 5 types of accounts. We have asset. Asset means what the business owns. We have liability. Liability means what the business owes. That is what they are owing. We have capital. Capital means owner's investment. We have income. Income means what the business earns. And finally, we have expenses. Expenses means what the business spends. Here is a relatable example. For instance, cash, laptop is equal to asset. We have loan, which is liability. We have owner's money, which is capital. We have sales, which is income. We have fuel, rent, which is equal to expenses. So instead of textbook style, let's make it very simple. Asset increase is equal to debit. Asset decrease equal to credit. Liability increase equal to credit. Liability decrease equal to debit. Income equal to credit. Expenses equal to debit. So if you understand this, double entry become, easy once you understand this basic. So if you understand this particular scenario, double entry will never confuse you again in this life. All right. So let me show you very quickly some practical scenario. For example, when owner introduce a capital in cash, for instance, I start a business and I bring in 500,000 naira cash. What came in is equal to cash, which is an asset. All right. Now it's to be debited into the cash account. Where did it come from? Capital, which is equal to credit. All right. How do you make the entry? You debit cash with 500,000 and then credit capital with the same 500,000. Now let's look at another scenario. For instance, when goods are bought with cash. For instance, if I bought goods worth 200,000 naira cash, goods came in, which is the purchase, inventory, which is the debit. All right, cash went out, which is an expenses as a credit. How do you treat it? Debit purchase with 200,000 and credit cash with the same 200,000 naira. It goes like that, like payment of rent. If you pay for rent of 50,000 naira, rent is an expenses, cash is credited, and the rent is debited. All right, so it goes like that, like that. So it is important that you must understand the double entry principle. How about when a situation when goods are sold for cash? For instance, if I sold my goods for 300,000 naira cash came in, which is a debit on the cash account. Sales is income, which is a credit to the sales account. How do you make the entry? Debit cash with 300,000 and credit sales with the same value. All right. So double entry is very important when you are to post transactions into the ledger. Post transaction through either via the platform of accounting software, either QuickBooks, Sage, or any other kinds of what we call accounting software. And so there are some common mistakes beginners make. For instance, mistake number one: debiting cash anytime money comes in without asking why. Mistake number two: forgetting the second account. You debit and you forgot to record the credit side. The next mistake could be like mixing personal money with business money. You have personal money, you mix it up. My advice is that always ask two questions. Number one question you must ask is that what come in and what went out. This is why double entry is very powerful. Double entry helps you detect error. It helps you prepare trial balance. It helps you to know profit or loss. And it helps you to track where money is going. Without double entry, your business is guessing. And when guessing involved in your accounting, you are finished in your business. So if you understood this particular video, type double in the comment section. As practical is unfolding, I will teach you how to post different transactions, making entry into the ledger that will affect trial balance, final account, and every other aspect of financial reporting. So if you want to become a confident accountant or business owner, follow us as we dive into the practical. All right? Accounting is not hard. You were just taught in the wrong way. But follow me as I show you the practical side of accounting as we make the entry through accounting software Excel version, which is developed by me. Let's get in. All right. Welcome once again. Today, I'm going to take you through on how to prepare financial reporting. The financial reporting that you have been hearing about. In other words, we are going to prepare a complete financial statement from the scratch using a given raw transaction. Supposing you are managing, or as a freelancer, you are managing accounts for a supermarket or a pharmacy or any other business. So for the purpose of proper understanding, I'm going to use an Excel accounting software developed by myself. So let us start from there. As we progress, we are going to use do practical on how to post on a QuickBooks accounting software like Sage and all of that. Accounting software like QuickBooks, Sage accounting software, Zoho Books and all of that. So to take you from the basic, we're going to make use of this particular Excel accounting software developed by myself. So here I have with me the raw transactions. Let's assume that you are an accountant that is managing this particular client business. All right, this is a small business, and let me take you through the raw transactions. Let's assume that the owner of this company is your client. But here with me I have APC Limited who start a business with $1 million. This person starts a business with $1 million. In the course of this business commencement, he paid rent at 5,000 US dollars. He bought computer and other office equipment at $50,000. He spent $200 on software development and testing. He spent $50,000 on marketing campaign. He also made a first sales, rather he made a first sales after the commencement of the business at 200,000 US dollars, and this sales was on credit but with a cash advance of 100,000. This means that this credit sales, a customer who received this credit sales was able to make a deposit of 100,000 US dollar out of the 200,000 total credit purchases. Then during this same period, he also make a sales worth of 280,000 and received cash immediately. He made payment of 5,000 US dollars as monthly rent expenses. Monthly rent expenses. Alright. The one he paid before was the rented office space. Then he made payment of 10,000 US dollars as employee salaries. Then he received payment from customer. Received payment from customer. Remember, a customer bought on credit of 200,000 US dollar before, made a deposit of 100,000. So this is the balance that is being paid by the same customer. Alright. Then he took a loan of 100,000 US dollars from a bank for 5 years to fund business expansion. At this point, the business is already growing. So this is a 5 years loan. It's more than 1 year. You know, we have long-term loan and short-term loan. So any loan that is beyond 1 year is a long-term loan, and any loan that you take, of which the repayment is taken between 0 to 12 months, is short-term loan. Alright. So he also borrowed 50,000 US dollars from a bank for 1 year to cover short-term expenses. This is referred to as short-term loan. And then he had a purchase of inventory worth 200,000 on credit. This time around, this client is the one making a purchase of what he's selling on credit from the supplier. So next, he also make payment of 1,000 US dollars cash for office supplies. Then second to the last, he received an electricity bill for 500 US dollars. And lastly, of course, when you are doing business, you make payment of tax to the government or the tax authority. They made payment of 10,000 US dollars for corporate income tax. So now with these transactions, this is a raw transactions. What I read is just a normal day in and out. You know, you buy, you sell, and you make payments. You buy on credit, right? So later you can refund them. You buy on credit from your supplier. Your customer also buy on credit from you. So this simple transaction is what we are going to transform into what I call income statement, cash flow statement, statement of financial position for this particular period. Okay. Now, and from there we'll be able to generate trial balance, different ledgers, cash account, equipment account, you know, loan account, and all of that using this same particular software. So here with me is the software that you are seeing that I display here. You can see in this software we have the chart of account. It's already, you know, configured already. Asset, liability, equity, expense, and revenue. Those want to be debited, and the account that is linked to. All right. So to avoid too much drama and taking too much the long length of this particular video. So let's begin the posting. So this particular Excel accounting software development, all you need to do is to make your posting. And before we start, if you don't know the principle of double entry, it's very important that you must know, because if you don't post it properly, you will not achieve the result. The trial balance will not balance, the account will not be normal. All right. So if you have not watched my video on understanding the principle of double entry system rather, you need to go and watch again. Or if your understanding of double entry system is not strong, you need to go and watch. I recommend that you watch that particular video. Double entry accounting system. It's very important, because you need to understand the account to be debit, account not to be debit, and why is to be debited, why total account is to be credited. So when you have a particular transaction, every account has two legs, has two sides. The one to be credited and that to be debited. That is how account has two legs to be balanced. All right. So let's go. Now, from what we read before, we read that APC Limited started business with cash of $1 million US. Yes, this is cash. This is not bank. This money you have in cash is not a bank balance that you transfer. So what we are going to do to save us the time, I have already imputed, I've already imputed what we are going to post each of those transactions. All right. So now we are going to make a post into this accounting software, right? So like I said, make sure you understand your double entry system of accounting to be able to get these things rightly. And if you have not watched that video, you go back and watch it before you can understand this particular training properly. All right. So the first transaction said that APC Limited starts a business on the 1st of March 2024. The 1st of March 2024. So what it means is that you have this money cash account, and this money is a startup capital. The money is starting up capital. The money belongs to the owner. It's owner's equity. It is referred to as owner's equity. Owner's share of the business is what they start with. And this money is in cash, not in bank. So what we are going to do by implication, by going by the double entry principle, is that the cash account, because this money is cash in his hand, the cash account is to be debited because the money is actually coming into the business, and the owner's equities to be credited because this is part of the owner's share. The money belongs to the owners, though is investing into the business. All right. So the principle of double entry principle recognize that in as much as it's the cash that is bringing into the business, the cash account is to be debited and owner's equities to be credited with the same value to balance the two legs all at the same time. All right. So what we need to do, we will have to post to debit cash and credit the owner's equity. But before then, let me take you through this software. You can see, so that you can know that this software is already blank. So as we are making the post, you see the effect. This is trial balance. You can see the balance is blank. Let me take you through the ledgers, all different ledgers account. You can see that is blank. It's blank here. So as I'm posting, we'll be checking the effect. You can see the income statement is blank here. This is the income statement. You can see that it's blank. You can see the net profit down here. Everything is blank here. You can see the balance sheet, the one we are calling lately. It's no longer balance sheet, rather statement of financial position. You can see that it's blank. All right. You can see the cash flow statement. Everything is automated with the help of advanced Excel formulas. All right. V lookup, X lookup, and all of that. All right. So let's go. Let's look at how the posting will affect this particular software and give us a summarized, accurate financial report for this particular client. All right. So first of all, the first transaction said that APC Limited start a business with a capital of 1 million US dollars. So what we need to do is to type, come here, this is a description, startup capital. You are the one that will type this because it's just a summary of the transaction. Startup capital. Now this is account type. So here you click on the drop down. You select the account that you want to credit or you want to debit. So the first one, I would like to debit the cash. Then you put the debit value 1 million US dollars. 1 million US dollars. This is 1 million US dollars. All right. So then we come here with the same description, just copy and paste the startup capital. In this time, having understand the principle, what the principle said concerning this particular transaction, that anytime you start up a capital with cash, you will debit the cash because the cash is coming into the business, and credit the owner's equity, that is owner's part of the money, because the money belongs to the owner but invested into the business. So we select owner's equity here, which is the account to be credited, the same value with the same value. This is 1 million. All right. Now the next transaction we have was paid rented office space at 5,000 per month. This is payment. All right. This is payment. It's not indicated whether it was for by cash or by bank or by any check. So what we are going to do, it is assumed that this payment is made in cash. Once a transaction is silent about cash or check, you take it automatically is cash. All right. So otherwise it will be stated that by check or by bank. All right. So what we are going to do is we type, the next one is office rent. This is office rent, the description. So in this analysis, I'll take you through. I would like to focus on one particular pattern. One account must be credited. So any one that is going to cash, if it has to do with cash, I will debit cash first before taking the credit side. All right. So office rent, I debit the cash because it said paid office space, not indicated either by bank or cash. So how much is 5,000 US dollar? 5,000. Then I come again, I copy, I paste the description, office rent. I come here, I select the account to be credited, which is rent account. Rent account is to be credited 5,000. So meaning no, cash account is to be credited, rather cash account is to be credited and rent account is to be debited. Rent account is to be debited. The reason is that every expenses you made is to be credited into the cash account. You make payment for any kind, even if it's by the bank. You know, 2-column cash book has a column for bank and a column for cash transactions. So this particular transaction has to do with almost everything is in cash transactions. All right. So then the next transaction said office equipment purchase, has to do with office equipment purchase, both computer and other office equipment at 50,000 US dollars. All right. Now, this is a cash transaction. We are not told whether it's paid by check or not. Now, we come here and say office equipment, office equipment. Now, this office equipment was paid cash. Since it was paid cash, cash account will be credited and equipment account will be credited with the same value. Now we come here and say cash account should be credited with 50,000. Credited with 50,000, and the same office equipment will copy and paste here. Then we come here, select the drop down, go to all this drop down is already configured during when I designed this particular software. So for those of you that are going for managing account for small businesses in the new year 2026, all you need to do is to just understand your principle of double entry. Once you make your entry, refresh the ledger, refresh the software, account is prepared on its own automatically. So this is a equipment account which should be debited, is an expense account. So every expense account is to be debited. All right. Then every expenses to be credited to the cash account. Then every revenue or the sales that you gathered over a particular period to be debited. Okay. So that is what the principle of double entry summarily directs every accountant to do. Okay. So the next transaction that you have was that he spent $50,000, 50,000 US dollars on marketing campaign. All right. Now, if 50,000 US dollars was on marketing, no, before then, we have an expenditure of 200,000 US dollars on software development and testing. Software development and testing is the cash transaction. We will now write software development, software development. This is software development. We talk about office equipment purchase. This has to be added purchase for clarity. Office equipment purchase should be office equipment purchase. This office rent, startup capital, okay. Software development, all right. So we credit the cash with how much? With how much? 200,000 US dollars, and type the same description. Credit your credit software development. Once you now debit research and development. Why is like that? Is because it is 200,000 on software development and testing for research. Anything has to do with software is for research purpose. So, and then we debit research and development with 200,000. So the next transaction we have was that he made an expenses of 50,000 US dollars on marketing campaign. So we come here and say marketing campaign. The next one is marketing campaign. This is marketing campaign. We debit the cash account. We credit the cash account with 50,000. Once we debit the cash account with 50,000, and we'll repeat the same description and credit advert and promotion. We debit advert and promotion with the value of 50,000. Having credited cash account with 50,000, the same value will be debited to advert and promotion as regard to the marketing campaign. So then the next we're going to look at after this next one, we refresh the software and see the effect of what we have posted so far. Now, the next transaction say that APC Limited make a sales of product worth make a sales of product worth 200,000 on 20,000 US dollars on credit with cash advance of 100,000. Now this is very simple. First of all, you need to recognize the total receivable, which is the 200,000 US dollar. Remember that this particular customer make a deposit of 100,000. This means it's still remaining 100,000. So first of all, you make a post of the total grand total receivable. Now you say credit, I will say credit sales, credit sales, credit sales, total account payable, total account payable, total account payable, account payable. I will debit account payable because the customer, this is what the customer is owing to pay. All right, and then I will credit revenue, that is the total revenue. So I'll credit account payable, I'll credit account payable, credit account, sorry, debit account payable, debit account payable, and then repeat the same description, then credit revenue that was earned during this particular period, revenue or sales, credit sales with the same 200,000. Now remember that this customer made a deposit of 100,000. So that means out of the 200,000 credit transaction this particular client made, it is only 100,000 that has been paid. And inside this 100,000 that has been paid, it is estimated that 50% of this amount to cost of goods sold. That means the 50% of this 100,000 that has been settled, which is 50,000. So we now come and say, we'll repeat the same cost of goods sold. But before we treat this cost of goods sold, let's look at the amount this particular customer has paid. We are told that out of this 200,000 credit sales, this customer deposit 100,000. So what we need to do is to say customer payment, this is customer payment. What are we going to do with it? We debit the cash, repeat the same description, and credit receivable, we credit account receivable, with the same amount. So this customer payment, account receivable should be credited with 100,000, which is the remaining balance. All right, the cash he paid 100,000. Okay, so that's how it is. Now when I goes to the cost of goods sold, so what is recognizing now out of the 200,000 credit sales, the actual cash received, what is spent to have realized that cash received so far on this 100,000 is 50,000. This is 50% on the cash received until when the remaining payment is made. So we'll now come here and say cost of goods sold, credit sales, this is credit sales again. If this is credit sales, we come here, which account are we going to debit and which account are we going to credit here? We will debit cost of goods sold. It's an expenses. It's an expenses. Scroll down. Where is our cost of goods sold? Which is 50,000. Then the same description goes for credit transaction. This description is not correct. Description is not correct. Then the same goes to credit transaction here. Then here we now credit inventory. Credit inventory account. The remaining one goes to inventory account because you still have the other leg of 50,000 receivable that has not been paid. So the remaining 50,000 will be credited to inventory until the payment is fully settled. Alright, so let's refresh this before we move further. Let's refresh on this and see the effect so far. I will click on data. Once I click on data, see the refresh, I'll refresh all. So once I refresh all, go and see the trial balance. You can see this is the trial balance. This is the trial balance. This is the trial balance. We have not finished posting. So by the time we finish posting, everything will take effect. The one we have posted so far is what is showing us. You can see the income statement. Look at the income statement. So we have not finished posting. The moment we finish posting, everything will take shape. This is the financial owner's equity. You can see it has appeared here. Look at the equipment we just post. It has appeared here. Under the cash flow, look at the receivable, 100,000. Look at the inventory, change in inventory, change in receivable. Look at them. It has appeared here. Look at the equipment in the statement of cash flow. So that is how it works. That is how this Excel works. So let's move further. Now, the next transaction has to do with the sold product worth 280,000 and received cash immediately. 280,000 and received cash immediately. Here we will say cash sales. This is cash sales. We select cash here. Then which account is to be credited and which account is to be debited? Cash account. This is a cash sales. Cash account is to be debited with 280,000. Then the same thing happen here. Then the revenue and sales account. Revenue or sales account to be credited with the same value, 280,000. Now the next transaction says paid $5,000 as monthly rent. Now he paid, so cash account of course to be credited and rent account to be debited. So rent payment, we type rent payment. Cash account, select cash account, which is to be credited with $5,000. Then we'll repeat the same rent payment. Here rent account is to be debited. This is rent account. We debit it with $5,000. Alright, so let's move ahead. We'll soon be done with this. Now the next transaction says that he paid 10,000 US dollars employee salary. Employee salary. So salaries payment. Here is salaries payment. Salaries payment, and each time salary is paid cash, you credit, whether cash or by bank or by check. Cash account is credited. So I select cash account here with 10,000 US dollars to be credited into the cash account, and then I repeat the same thing here, and then I debit salary account. Where is the salary account? Salary expenses account. Salary expenses account with the same 10,000 US dollar. Then the next transaction says receive payment from a customer, which is what we have already treated. The balance, the remaining balance of 100,000 that we treated as receivable. So we have the next transaction has to do with borrowed 100,000 US dollar from a bank for 5 years. This is a long-term loan. It's a long-term loan. So we come here and say long-term loan. This is a long-term loan. So you come here and select long-term liability, long-term loan liability. We have long-term loan liability. We select it. So this money he received. So as long as this money was received into the business, cash account is to be debited. All right. So I will debit cash account with 100,000 US dollar, and then we come here again and repeat the same description and select long-term loan liability, and credit it with the same 100,000 US dollar. So once that is done, we'll move to the next transaction. The next transaction borrowed 50,000 US dollar from a bank for 1 year to cover short expenses. So this is a short-term loan. The same way we treat this one. So what we need to do is to copy and paste this one and change this long to short-term loan. Then of course into the cash you receive it, and it has to be debited, which is 50,000. Then we repeat the same description for the other leg based on the principle of double entry. Then we come here and say is to be credited, the other leg will be credited to the short-term loan liability, which is 50,000 US dollar. Alright, this is 50,000 US dollar. Then the next transaction said purchase inventory worth 200,000 on credit. This is on credit straight, no part payment. So this will carry 4 legs. It's carrying 4 legs because its transaction was on credit, right? Okay, this is carrying 2 legs. This will carry only 2 legs. Yes, it will carry only 2 legs. Yes, inventory purchase on credit straight up, right? So now what are we going to do? Which account is to be credited and which account is to be debited? Now because this inventory that he purchased, as the owner of the business is the one that purchased this, the inventory account is to be debited because he's still owing on this particular inventory. All right, now the amount payable, account payable will be credited because he's expected to refund back this money that he collected as a burden. So what we are going to do is to say inventory purchase, When we say inventory purchase, we say inventory account to be debited. We debit inventory account. And I've explained before, this is taking credit into the business. So you are debiting because the burden is still there. Account payable means what is still expected, the burden, the financial burden, as far as this particular transaction is concerned. Payable means is what you are owing, expected to pay. All right. So the value of inventory increase, and that is why this inventory account has to be credited. Right, so we debit inventory account with 200,000 US dollar, and then repeat the same inventory purchase on the description. Credit account payable. Where is account payable? We select credit account payable. Credit account payable. Now the purpose of this training is for you to understand how postings are done in accounting software generally. Okay, so the ability to understand double entry system, you have to watch the other video, all right, and make more research about it and learn more on principle of double entry. It's as simple as that. So the next transaction is paid. The client paid 1,000 US dollars cash for office supply. All right, so what we are going to do is very simple. We come here and say inventory supply into the office, inventory purchase again, then this is cash. We debit office supply accounts with how much? 1,000 US dollar. You repeat the same inventory purchase and credit cash account. Credit cash account with 1,000 US dollar. Credit cash account with 1,000 US dollar. Now the next transaction is that he received an electricity bill for payment, which is 500 US dollars. So we come here and say, which is on the next date, is electricity. We call it electricity bill. So here we debit utility account, debit utility with how much? 500 US dollar. We copy the same electricity and credit cash account with the same value, 500 US dollar. Then the last transaction is tax payment. He paid tax of 10,000 US dollar for corporate tax. So we have corporate tax payment. Corporate tax payment. We debit corporate tax, debit income tax with 10,000 US dollar. The same description, and then we credit cash accounts with the same 10,000 US dollar. So that is the end of this transaction. So all we need to do, we need to see the wonder of the software. So I go to the refresh, I refresh the software, click on data. Once I click on refresh all. When we did it to the half, that time I showed you the effect. So this is the last half of the whole transactions. So I have refreshed it. So let's begin to look at how effective it is at the end of this transaction entries. All we have done is to enter all the raw transaction into this particular journal, and it's the same thing that happened in accounting software. You just know your double entry, and that is how you post into accounting software. So you must understand the account to be debited and that to be credited, and why it must be debited, so that you won't make a mistake. Otherwise, account will not balance at the end of the day. So let's start from the trial balance. Look at the trial balance. This is the trial balance: 3,214,000, 3,214,000. You see, 3,214,000, 3 million. That means the trial balance, there is no case, no issue. You can see this is a trial balance. Then we go to the income statement. Look at our income statement. This is the income statement. Look at the net profit, which is 146,000 US dollars. All right, at the end of the period. Now, remember I showed you that once everything was blank on this software before we make that entry there. So, statement of financial position. This is a statement of financial position. You can see everything as we are making the entry. It enter here. It's every angle and reset the account on its own. Look at it. Total asset is now 2,396,000, 2,396,000 asset plus equity and all of that. So look at the cash flow. This is the cash flow statement. You can see everything is automated. So if you are interested in this particular software, you kindly DM me. It's not free, but with a small little token, you will get it. If you want to go into a freelance, you want to help small businesses to manage their account, all you need to do is just enter their transaction, all they have in the whole month, enter them through the general ledger and watch my double entry system of accounting properly, and you are good to go. But if you want to know how to build this particular software, I will do a video on how to build this accounting software using Excel version, so that you can also learn and build your own, maybe probably to your own taste. All right, so look at it. So we'll go back to the ledgers, how the ledgers are affected individually. You can see, look at the income tax. At a click, I have, after posting all the transaction, you can see now this is account payable, this is advert and promotion account, this is equipment account, non-current asset. You can see long-term liability account. You can see this is salary account. I go back, look at the salary account, look at utility. You can see the utility here. We have rent account. Look at rent account. Look at inventory. This is inventory account. You can see them. So everything is set. That is how to make a post into accounting software, being it QuickBooks, being it Sage, being it Excel version. It's the same understanding of accounting principle you must have for you to make necessary posting. So you wait for my next video or training video on some other aspect of accounting. God bless you. If you need this particular software, kindly let me know. And if you want me to teach you on how to build this particular software by yourself, to build it up to your taste, kindly drop your comment, drop your opinion in the comment section. All right, thank you. Bye until we meet again.